Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And as always, Michael Becker is in the house with us.
Hey, Paul.
So we're in for a treat today because today we're going to learn a little bit about valuation. And so valuation is, what's the value of multifamily properties, how it is conceived, how it is devised, where the information comes from, how it's all put together. So who's going to lead us on that path today is Aimee Morgan with CBRE, the valuation team here in Dallas. And so she's going to talk a little bit about how these transactions are put together to make sure that we understand how collateral is appraised. So, Mike, I'm going to kind of kick this over to you because I know you love talking about collateral.
No one loves that more than me, right?
As a former banker, you know all this stuff.
Well, thanks, Aimee, for coming on the podcast. Maybe you just kind of start off by giving everyone a quick little background on yourself and, kind of what you do and how you got there.
Absolutely, and I'm glad to be here. I'm a commercial real estate appraiser. I'm general state certified, and I have been practicing commercial real estate and practicing and specifically specializing in multifamily for about 6 years now, a little over 6 years actually. I majored in real estate in college. I went to Baylor University, go Bears, and so my foundation is 100% in commercial real estate, and the appraisal tract is a not often sought after one. But I knew I wanted to go into appraisal, and so I went into appraisal straight out of college.
That's great. So maybe just start with kind of the basics, like what does an appraiser do and kind of what's your role in any given deal?
Yeah, that's a great question. So the appraiser's role in any given transaction is to tell the bank what the collateral is worth, market value. You'll hear me talk about market value a lot, so that the lender or the bank can make an educated lending decision. There's a distinct difference between valuing a property and underwriting a property. And I'll talk a little bit about that as well, the difference between the pro forma that an appraiser would use and underwriting.
So before we go there, what does it take to be an appraiser nationally or in the state of Texas specifically?
Yeah, so it's not an easy track. There are about 300 coursework hours that you have to take outside of your degree. All appraisers have a college degree. That's a requirement. And you complete about 300 hours worth of coursework. You have to practice for about 2.5 years before you can be licensed as an appraiser. And then you also have to pass a general state exam, and it's a rigorous one. So appraisers are highly qualified. They're highly experienced in their field. There's a reason that we tout our expertise. We work very hard to become certified.
Sure, yeah, it definitely sounds like it. So maybe a new person and looking to do an apartment or relatively inexperienced, but most people own a home. So maybe you can kind of explain the differences between what a commercial real estate appraiser does and what someone that just does your basic run-of-the-mill single-family house.
Good question. So the requirements for licensure between single-family appraisers and commercial real estate appraisers, commercial appraisers always appraise apartments because they're commercial properties, even though they're residential, are very different. The requirements are very different. Much less experience is required to become a single-family appraiser, and less coursework is also required to become a single-family appraiser. And single-family appraisers are very focused on just the sales approach and just the cost approach. They're very comp focused, and there's no income analysis in single family appraisal. So it's a very different thing than what we do. We're almost 100% income focused, and then we test that approach with a sales and cost approach.
So maybe that's a good transition. Maybe you kind of explain, how do you value an apartment complex from an appraisal standpoint? The three methods of valuation and the types of values that you guys can go out and produce, and then maybe kind of go back to your earlier statement of the difference between what a pro forma value is and how you appraise versus how other people actually underwrite.
Got it. Yes. So there are three approaches to value. I'll start with the cost approach. The cost approach is just that. It's estimating the value of the land and then the cost to build the subject property, less any forms of depreciation. That's the value via the cost approach. The sales comparison approach is a selection of a number of comparable sales. Typically, those sales are adjusted for different factors, as would be naturally appropriate. And once you adjust all those sales, you come to a conclusion via the sales comparison approach. And then the third and most important approach for any commercial property is the income approach. In the income approach, we estimate what we call pro forma income and expenses. We're focused on the historical operating statements when we do that, but the pro forma is not necessarily the historicals. And so you'll hear me talk a lot about pro forma. That's what I'm talking about. Pro forma, in theory, is the first operating year at any given property after acquisition. Every appraisal assumes an acquisition. It's the assumption of an appraisal, even if there isn't going to be one. If it's for a refinance, the appraisal still assumes an acquisition.
Right. So what would be some common things that you need to go in and make adjustments from, say, a seller's historical financial statement to what you're going to have in your pro forma in your appraisal?
Very good question.
Thank you.
We see a lot of operating statements doing what we do.
Sure.
We see hundreds and hundreds of properties. So we have the benefit of seeing lots of operating statements and how lots of different people are operating apartment properties. And from all of that data, we can derive some trends. The biggest thing that we tend to adjust for on a pro forma basis is payroll. If a property is over or understaffed, management fee. If a buyer can get a more advantageous management fee, then we definitely consider that. And we also look at insurance. Property taxes is a hot topic. We'll probably want to touch on that just a bit. And then advertising is a big one.
And sure, so market vacancy as well, right? So if they're historically are lower, you guys either would adjust up or down depending on how it compares to the rest of the comparable properties in the market, correct?
Yes. When we compile this pro forma, it's always on a stabilized basis. And then if the property is unstabilized for any reason, we adjust for that, what we call below the line. So after we calculate stabilized NOI, any adjustment for a lease up or deferred maintenance would be made below the line.
Got it. So it's good. So one key thing I think I like to stress, I know Paul and I always talk about, or we get these questions sometimes that some of our borrowers might come to us and say, hey, have this appraisal from the seller. Can we use this instead of using a loan? Can you use a different appraisal that the bank didn't order?
That's a good question.
You're full of good questions.
It's like I'm a professional here, right?
Yeah. You can. It is possible. What you would have to do is go to the seller and ask them to release that appraisal to you or to your lender.
Bank.
And then your bank would need to go to the appraiser and say, can you please reappraise this property for us as of the same date of value that you used in the previous appraisal?
Got it. So short answer is no. So you got to get the bank to order your appraisal. That's generally the answer, right, Paul?
Yeah. So what happens, and this happens every once in a while, let's say a transaction is turned down and the appraisal was ordered by that bank, and now we have to use that appraisal for another bank. We have to get a thing called a reliance letter, making sure that appraisal was ordered by like an FDIC or an appraisal management group that ordered it, that we didn't order it, and that somebody can rely upon the valuation. So a reliance letter is required, but you need to get the release from that bank. You need to get the release from appraisal company to have them even put the appraisal in the new bank's name, because that's important, because the appraisal is really owned by the old bank, not owned by the new bank. So I need to get that appraisal in the new bank's name.
You brought up reliance letters, and reliance letters can only be issued between lenders. Appraisers cannot issue a reliance letter for an old appraisal. But I kind of mentioned the term reappraisal. And typically, if there's not much time between two appraisals, the second appraisal should be much cheaper than the first one.
Sure.
Yes.
Yeah, a lot of the field work's the same and less time to do it, for sure.
Exactly.
What we do here at Old Capital is a lot of multifamily. So it's primarily what we focus on. We do some of the other asset classes, but when you're assigned an appraisal, maybe you can talk some of the differences, because the main two types of loans that we do, either Fannie Mae, Freddie Mac will kind of put agency in one bucket, and then just like a regular commercial bank. So maybe you can talk through some of the different requirements that Fannie Mae or Freddie Mac would put upon you versus, say, you just go to like a regular community or regional bank. How does that differ from your perspective in your job assignment?
Yeah. So Fannie Mae and Freddie Mac, the agencies, as we'll call them, have a lot more rigorous appraisal requirements than community banks or even conduit type lenders and life companies as well. One of the biggest differences is that for agency loans, we need more detailed operating history. We look at the expenses on a more detailed basis, and we break out more categories for the expenses or buckets for those expenses. Sure. And then also Freddie has some very specific inspection requirements for us. So typically when we do an inspection for a Freddie Mac appraisal, we come in and we have very specific requirements, and it might seem like we're being bossy, but we're just following our requirements from Freddie.
Gotcha. So in this environment, maybe kind of go back in time 10 years ago and kind of reflect and see how today is relative to, say, 10 years ago before the recession, before Dodd-Frank. How has your job changed? How's the environment changed on what the appraiser's job and what they're charged to do for the lenders?
Yeah, that's a great question. There's always a lot of scrutiny put on appraisers, especially when things go south as they did in 2008 and 2009. Do we blame appraisers? But from our perspective, we're always trying to reflect the current market. So back in 2006, 10 years ago, oh my goodness, wow, time flies, doesn't it? Things were very, what I call frothy, and the market was very aggressive. And so appraisers were very appropriately reflecting the aggressive market in their appraisals. The thing about value is that any given value is as of a specific date and time. And if things change, the economy, demand drivers, anything, think about the day before 9/11 and the day after 9/11, things were very different on those 2 days. And so any change in the economy changes the value. And that's why data value is a very important thing in the appraisal world. But overall, I think things are different this time around. Everyone is a bit more conservative. In my opinion, everyone has been very careful and calculated in all of their assumptions, and I think we're kind of on a good path right now.
Well, that's good to hear.
So you're absolutely right. An appraisal is like a photograph. It is a specific time and place. It is not a movie. So it's a specific day. It is not 2 or 3 hours of watching a movie over a period of time. Any common mistakes that buyers have, that borrowers have, people that are looking to refinance their property, what are some common mistakes you're seeing for people make for appraisers?
A big issue that we have is getting information that's after the date of value, like an updated rent roll or, oh, we went and replaced the roof after the date of value. Can we consider that in the appraisal? No, we can't, because it's after the date of value. It wasn't real as of the date of value. So new operating statements, new rent rolls. An appraisal isn't a living document, and it can't just be updated with new information. It requires an entirely new appraisal as of a new date of value. So that's one common thing that comes up in relation to date of value. Overall, to your question of common mistakes from buyers, the biggest one is just not getting us the information that we need. We really do need that information when we ask for it. And so if you get us the information that we need, we will go and do our thing. And we're pretty good at what we do.
Let's talk a little bit about, everyone on the multifamily side kind of has an understanding what expenses are on a unit, whether it is a two-pipe chiller or an individual HVAC, kind of understand payroll, kind of understands this and that on the expense side. Sometimes we have borrowers that have too much expenses, and sometimes the borrowers have not enough expenses. They treating the property very thinly on the expenses. Maybe they're not fixing stuff, not enough money for repairs and maintenance on the property.
Or they collect rent themselves, like mom and pop it, and work in the office and not pay themselves a salary, right?
That's exactly it. So we can certainly see swings of expenses, too much or too little. How do you guys treat that?
We approach expenses on a market norm basis. So as I mentioned, we see hundreds and hundreds of properties every year. And so, we see lows and we see highs, but every time we appraise a property, we put ourselves in the shoes of a typical buyer. And what does a typical buyer look like? A typical buyer isn't your mom and pop buyer. And it also isn't your large institutional buyer either. It's somewhere in the middle. And it might be different for any given property. For a Class A tower in Uptown Dallas, your typical buyer is going to be very different than for a Class C property in Arlington. Sure. So we always put ourselves in the shoes of a typical buyer, and we want to know, what do we think a typical buyer would operate that property for? We call that our buyer's hat. So we always put our buyer's hat on when we're appraising.
That's good. So we do quite a bit of value add lending here at Old Capital. So from your experience or from what you see, what are some of like the best strategies that some of the ownership groups have implemented? Like what gives the bang for the buck when you appraise a property on acquisition and you do a renovation and then you appraise that same property 2 years later? What's some tips or what's some things that people should be looking for?
Unit interior upgrades are probably the biggest value add component for Class BC product in this market. Exterior renovations go a long way. If a property has poor curb appeal, improving the curb appeal really helps in just bringing tenants in, getting that foot traffic into the leasing office. But it's the interior upgrades and amenities that really increase rent. And it's a rent increase that increases value. So new appliances, new countertops, refaced cabinetry, updated flooring, fixtures, things like that are really adding a lot of value. Adding amenities, dog parks are very popular. In Texas, I think it's something like over 75% of apartment renters are pet owners.
Oh, wow.
It's pretty high.
Shockingly high.
Mike,
Yeah.
I mean, on some of your properties, Mike, you have dog parks. How do you like that, and why did you do it?
Like Aimee was mentioning, that a lot of the residents have it. It's a relatively cost-effective amenity. You can put a dog park up for between $5,000 and $10,000 depending on the size, and you can spend more if you want like one of those pet washing stations that one of our friends does on some of his properties. But then you not only, if you have a pet, like you said, if you have a nice pet park or a dog park on your property, they'll likely be more likely to rent there, stay longer, and then you can charge pet fees and pet rent as well and increase your bottom line.
Yeah, there's a sense of community that comes when you have a dog park on the property, which instills people to stay longer because they meet friends at dog parks. And that's a big thing. I mean, we love dog parks on properties. What other amenities, Aimee, are you seeing out there?
Well, one thing I'm seeing phase out on is the traditional business center. People aren't using the business center that you think of with, 5 computers and a printer. Mm-hmm. Everyone tends to have their own computer these days. And so what tenants like better are some work from home type nooks, some smaller entertaining spaces. Rather than having a big, expansive, open clubhouse, turn that clubhouse into 5 or 6 different little nooks or entertaining spaces that tenants can use. With apartments getting smaller and smaller, tenants are always looking for a place where they can entertain their friends and family when they have a few more people than they might want to have in their apartment. And also with technology, what it is today, a lot of people are working from home. So if they have a great place where they can get out of their apartment and work from home, that's a huge selling point for a lot of apartment tenants.
I've seen even those little work pods, think pods you see at, say, an executive suite place like Regis. Have you seen those in some of the new product?
I have, yes, and they're very popular.
Take a note. There you go. So
write that down.
Before we transition over to kind of the state of the market, is there any other things that someone who is new or relatively inexperienced with borrowing money to buy a commercial property, specifically an apartment, they should know about, they can do to help their likelihood of getting a good result? Anything else that you want to add here?
Not yelling and screaming at the appraiser. That usually doesn't work.
That doesn't work,
okay.
yeah.
We don't take to that very well, no. Get us all the data that we need. Be sure and tell us what we need to know about the property. You've probably spent a lot more time analyzing the property than we will. We're quick in and out. We can do that because we're good at what we do and we see a lot of apartment properties, but we don't have the time to dig in and really get down to the nitty-gritty like you have. So give us all that information. Tell us what's pertinent. If it's a value-add deal and you've got renovations, tell us what your budget is. Tell us what you think performance is going to be like after the renovations. It's a lot better for us to hear your opinion. It doesn't mean we agree with it, but it's better for us to hear it than guess ourselves. If we guess ourselves, we'll probably lean on the conservative side. But if we have something from you as the buyer, it's something to go off of as a starting point for sure.
I like to use the phrase, everyone buys a story. That's whether you're the buyer of the deal, you're the equity I'm trying to raise, or the appraiser you're trying to get to give you good value. So if you have a good story like Aimee was saying, or you have high utility bills because you had a water leak and it got fixed 6 months ago and this bill just had a whack, you should let them know that so they can then take that into account and underwrite a lower operating cost.
That is a great point.
Thank you, Paul. So
yes, we always need the story.
Yeah, because what we have seen on some of these properties that the utility bill comes in a month, 2-3 months later, and you don't recognize it, that all of a sudden you went from paying $3,000 a month in water to $7,000, and now you're entering that on your expense side, and all of a sudden you figure out you fix it 3 months later, but you still have that bill going for the next 3-4 months. I would take a look at it, the trailing three, I would annualize that, and that would be 3 times or 4 times the amount typically you'd have in water. So keep an eye on expenses.
That's right. So let's kind of transition over to just the general state of the multifamily market. We'll take a few minutes there. Maybe you can kind of just do a quick little rundown of your opinion of the national market, the Texas market, and maybe more specifically Dallas-Fort Worth. That's where we're based out of, and you are as well.
And give me you're the lead in the group. How many appraisals will your group do just in the state of Texas and let's say the multifamily side?
Just in Texas on the multifamily side, we probably perform about 1,500 to 2,000 appraisals a year.
What about across the nation?
Across the nation, I don't know exactly what that number is, but it's thousands and thousands and thousands.
Got it.
It's a lot. We have apartment specialists in every major market, and it's very important to have an apartment specialist appraise apartment properties. There's a lot of nuances to apartments that would not be caught by an apartment specialist.
And you are absolutely correct, and that's why we do like the CBRE footprint that extends out the entire nation. In Texas, we have a thing called privacy on data, and so we cannot share what these properties have closed at. And so with that, it becomes difficult. If somebody's not into it on a day-to-day basis, if an appraiser's not into it on a day-to-day basis, they have no idea what has traded, and they can't use that data, and people cannot share that data back and forth. And so you guys are a great resource about what's going on. So that's why we like to use CBRE on the appraisals, because since they do so much, they have the most current data about what's going on. They do a lot of different appraisal types, products, but they're experts in the multifamily side.
So kind of with your hundreds of thousands nationally and tens of thousands here in Texas, what do you kind of see? What's the pulse of the market right now, in your opinion?
So I'll start nationally and I'll funnel in. Nationally, demand is strong. Occupancy is very strong. Major markets are performing very well, and secondary and tertiary markets are performing very well. We expect to see a little bit of softening in the rent growth that we've seen over the past few years. A lot of that is because a lot of new supply has come on nationally, and that's going to just slow rent growth a little bit. But we are still in a growth stage of the cycle. We're still experiencing rent growth, and we expect to continue to experience rent growth nationally going forward for the next 2 to 3 years, which is a great sign for us locally. So I'll move to Texas. Texas is outperforming the nation. We've got some great economies here. Despite the decline in oil prices, Houston has held on and is not in any kind of major decline. Houston is not what it was in the 80s. It's not 80% driven by oil and gas like it used to be. And so Houston is remaining a strong market despite oil prices. Austin is a very solid market. Austin has had tremendous rent growth over the past few years. It has not experienced as much new supply as some of the other Texas markets. And so that's really driving a lot of rent growth in Austin. So that's a fantastic market. San Antonio is a more stable but consistently growing market. So performance metrics are also very good in San Antonio. And Dallas-Fort Worth has just had unprecedented in-migration and population growth over the past few years. And really it's going to continue over the next few years. That's really driving a lot of great apartment demand.
So you were talking about the new supply coming in. You mentioned that a few times. I mean, so DFW leads the nation in new product being delivered. What's your opinion? How is a new product impacting other Class A? Because the vast majority of it is Class A product. So how's that kind of competing with existing Class A product? And then what's your take on how that's affecting the lower class properties, the 80s and older product, the B and the C space?
So all of the new construction that we've experienced is a little bit scary, but it's not if you look at the fundamentals. When you look at total number of housing units, both single family and multifamily that are being constructed in Dallas-Fort Worth right now, and then you look at population growth and expected in-migration with companies like Toyota, JP Morgan Chase, Amazon, all coming into the area, I don't think we're going to have nearly enough housing units going forward. So I think that demand for housing units in Dallas-Fort Worth is going to remain very strong until we have even more new construction. So even though we're at some pretty high levels as compared to the nation, we are still not at our 20-year high for Dallas-Fort Worth, and we're really lagging demand. So that's a very good thing for apartments. All the new supply has dropped average occupancies for Class A product just a tad. It's really only because there are so many properties being completed that there are so many in lease up. It's kind of driving that average occupancy down. But overall, Class A properties that have already reached stabilization are maintaining that stabilization and are really performing very well. They're seeing great rent growth.
We haven't seen on the A product, you haven't seen a whole lot of concessions on renewals on some of the second, third round, or is that in the marketplace right now?
Not yet. The only place where we've seen a little bit of concessions happening is in the Uptown submarket, just because of the sheer amount of new product hitting that particular submarket.
But suburban, Cullen County, Denton County, the A product is stable and not having to give concessions on renewals?
That's right. It's staying pretty stable. So concessions are at a real minimum right now.
Has the A product had any impact, negative or positive, on the rates in the B or C space in your observation?
I think it's had a fantastic impact on the BC product. As rents are rising and Class A product is becoming more and more expensive, that renovated Class B or renovated Class C is becoming a lot more attractive to tenants in this market than it ever was before. When you look at rent to income ratios, we still have a lot of room for rent growth, meaning our tenants can still afford to pay more rent than they're paying now. So that bodes really well for future rent growth. And as the Class A rents continue to grow, it's going to bring up the Class B and C rents with it.
Gotcha. Okay. One of the things I've been hearing a lot about and reading a lot about, we don't do a lot of it here, but construction lenders, that the regulators of the Fed is putting the kibosh on new construction loans. Is really, trying to nationally and even here locally in Texas and DFW, that the feds are getting pretty concerned about all the construction. Have you felt that from year in? You're an appraiser, you work for banks. Is that what I hear? Is that true?
That's a good question. I think it's kind of early to tell if that's going to have a huge impact on new construction. I will say that I haven't seen any fewer, we call proposed deals, new construction appraisals than we have in the past. But if you look at multifamily permitting for the first 2 quarters of 2016, it is slower than 2015 was. Now, I don't know if that's because developers have, run out of sites to build on, B, have slowed a little bit just to be conservative, or if it's C, financing related. It's kind of hard to pinpoint exactly what that is, and it's kind of early to tell if that's really going to impact us.
Gotcha. Speaking of, just one more thing on new construction, how have you seen the cost of it? You guys do a lot of new construction appraisals as well. I don't play in that space. I'm just mainly a B and C guy, but what I hear, labor, construction materials, land, impact fees all have just skyrocketed over the last 5 or 6 years. Is that the case? I mean, do you have a sense of what it kind of costs to build today relative to what it was 4 or 5 years ago?
It's increased tremendously. A lot of that is just your land acquisition cost. Land values have gone up tremendously since 2011, 2012. I mean, you couldn't really get rid of land back in '08 or '09 if you wanted to. And now it's just highly sought after. So land acquisition prices have gone up and construction costs have gone up significantly. And it's simply because we have a lack of laborers here in Texas. So it's the labor hour cost that's really gone up.
Yeah, that's great. So maybe kind of transition over here too. Speaking of today versus a few years ago, how have you kind of seen cap rates for by asset class, by A, B, C? How have they moved from 4 or 5 years ago to kind of where are they today? And then what's kind of your opinion, maybe your crystal ball a little bit of maybe going out 12 or 24 months on cap rates?
Yeah, hot topic. So from 4 or 5 years ago, oh my goodness, we've seen a tremendous drop in cap rate, probably about 150, almost 200 basis points on a lot of different property types. We're seeing them mildly decrease over the past 2 to 3 years. Everyone thought, oh gosh, they can't ever get lower than this, and they've continued to decrease a little bit. It's really driven by the amount of buyers in this market that are looking to acquire properties. And until there's some sort of alternative investment that's as good as or better than apartments in this market, that capital is going to continue to be competitive in that space, and it's going to keep cap rates low. With interest rates low, that also keeps cap rates low, but I'm not a huge believer that interest rates are highly correlated to cap rates. I think it's a lot more about buyer competition than it is about interest rate, although it does have some impact on cap rates.
So a lot of what we do here at Old Capital would be, say, C or B, garden style, generally more suburban. We're not doing a whole lot of complete infill type projects. Here in DFW, what would you say like an average cap rate would be for like a suburban, well-located suburban B and a well-located suburban C, generally speaking here, kind of a range?
I'll give you a range for Bs and a range for Cs. I think that the B range is anywhere between 6 and 7, and the C range is anywhere between 7 and maybe 8.5. I think the highest cap rate I've seen over the past couple of years was an 8.75.
And those are all stabilized cap rates that you're giving me?
All stabilized, always stabilized.
And
yes.
so from your opinion, I'm an active buyer here, so that's one of the challenging things that we're trying to go out and find properties that are undervalued or underperforming that have some upside in it, and those are the most desirable product on the marketplace, seemingly, at least my perception at least. So we're having to kind of almost even overpay, pay a lower cap rate just because we have so much upside in the deal. So the seller is getting paid part of my upside. So our internal struggle we always have is how much do you overpay? You have to overpay, but you don't have to overpay by too much, right? So it's kind of like the fine line. Do you have any general take on that and what you're seeing kind of in the marketplace on the value add versus the stabilized and kind of the cap rate compression you have when you have a value add property?
I think it's something like 25 to 50 basis points for upside, and we see this a lot. For properties that have a lot of future income upside, buyers are definitely using lower cap rates. How much is it for any particular type of upside? I think that varies, but I think it's anywhere between 25 to 50 basis points.
Okay.
Yeah.
Gotcha. Any macroeconomic drivers that have you either bullish or concerned, specifically for apartment spaces nationally or here locally in DFW?
Yeah, well, I would describe our mood right now as cautiously optimistic, which probably describes most of the apartment world right now. But when you look at Dallas-Fort Worth, the macroeconomic trends here are just really rock solid right now. We've still got employment coming in from some big employers like State Farm, Liberty Mutual, J.P. Morgan Chase, Toyota. And when you look at organic population growth, it's always been strong in Dallas-Fort Worth. And so I think as long as we continue to have that solid demand for residential units, apartments are going to continue to perform well.
That's great. Kind of last few questions here. Maybe we were talking before we got on mic, some of the challenges that I think we both have been going through here lately is all our properties got reassessed for taxes here lately.
Yeah.
So that's been a big thorn on a lot of people's sides here that do what we do for a living. What's kind of your take on that? How are you guys handling these taxes? Because the tax assessors have come out just guns a-blazing this year, and just I thought last year was a catch-up year, but evidently this year's a catch-up year. That's got to be a struggle for you guys at this time of year when you got noticed, but the values are going to be lower. So how are you guys handling that, or what's kind of some general comments on that?
Yeah, very hot topic. And I think guns a-blazing is the right phrase. Yeah. It's been almost excessive on a lot of properties. But here's my crystal ball take on the situation. I think that prudent property owners are going to protest their assessed values, as they should. The system is set up right now to reward property owners who do that. And so I think that we will see a huge lowering in assessed values at the end of the day. I just think that they are going to have a hard time proving that the apartment market has improved 40 to 50% year over year. That's a difficult battle to fight. And so I think if property owners are persistent, that those assessed values will be lowered.
So how does that impact you right now when you're trying to appraise a property? And last year their taxes were $200,000. This year they're $300,000.
Yeah. It's a tricky situation. What we do is we look at a few things. We look at what was the property assessed for last year? What's the preliminary assessment for this year? What are their closest comps, which is typically the immediate competitive set, assessed at? And then what do we think buyers' expectations are? Would a typical buyer expect for that assessed value to come down a little bit? Would they expect it to go up a little bit? Often we pro forma an assessed value above the current assessed value. Not as typical during this time period where we have these preliminary 2016 numbers that can be crazy high. But we look at all of these factors and we decide what do we think is truly the stabilized pro forma assessed value.
Gotcha. So any other challenges besides taxes that are kind of unique to this environment right now for doing what you do? Is that's the biggest issue right now?
That is the biggest issue right now. I will say that if you are mid-appraisal process right now, one of the best things that you can do is tell your appraiser that, by the way, we are protesting the taxes. Here's what our consultant thinks that we can realistically do. Or if you have an initial offer back from the appraisal district, that's definitely a worst case scenario number, and it's often at least lower than the preliminary 2016 number. So that's helpful information. If you could just let them know where you're at in the process, it helps the appraiser kind of make some decisions.
Yeah, so I'll want to hammer that point home because we're going through a couple appraisals right now, and that's a big challenge. So everyone who listens to this, and you're going to get the same situation next year, make sure you do that. So have your tax consultant give an analysis, share that with your appraiser, and then definitely if you have an offer from the appraisal district, make sure you let that's known because that can have a material impact on your sizing. Kind of really the last thing I want to kind of talk about. So the majority of our people are here in Texas and DFW. Maybe kind of hit the top 2-3 markets here in Texas, and maybe say kind of what, in your opinion, you think the best asset class, the best submarket for future next 12, 24 months. What do you think is going to be the best performing B class in North Houston or whatever? Kind of go over the top 4 markets in the state and maybe tell everyone what your opinion kind of going forward is.
Great. Yeah, I think top 4 markets: Austin, Dallas, Houston, San Antonio. Maybe not in that order. I tend to favor Dallas-Fort Worth, but I'm biased because that's my home.
So if you're going to buy in Dallas-Fort Worth, what class of property would you buy? And then kind of maybe one of the top 2 or 3 submarkets. What do you think is going to be the best performing going forward?
Yeah, definitely depends on what your goals are, your investment goals. But I think there's a lot of potential in the value add space, the B/C product in Dallas-Fort Worth, where you can go in and do some upgrades and add some amenities and raise the curb appeal and drastically improve the NOI at that property. I think that's probably one of the best plays in Dallas right now. Submarket-wise, I like North Arlington. I like Irving. I like Richardson. I like Denton. It's a very solid submarket. I like East Fort Worth, and that's kind of
Really?
a surprise.
Yeah, that's a surprise.
It is. It's kind of a traditionally poorly performing area, but I've seen a lot of turnover recently, a lot of renovations, and it's kind of looking like an up-and-comer. It's had some pretty impressive rent growth over the past year. So if rent growth is your goal, that might be the spot for you.
What about, say, San Antonio or Austin? We do quite a bit of business down in San Antonio and Austin. What are maybe a couple of little submarkets down there that you like?
Ooh, I'm not as good with submarkets in those other markets as I am in Dallas.
Okay.
But I like Austin because of its lack of new supply. I think it's going to continue to experience really fantastic rent growth because construction has been a little slower in Austin. And I like San Antonio because I think it's a very stable market. It's always been stable, even during economic downturns. San Antonio tends to stay a little bit more stable than the rest of Texas.
Gotcha. Well, put Paul on the spot. What you do a lot of business down in San Antonio, Austin, more so than I do. What submarket or two do you like down there?
I like it all. To tell you the truth, I like San Antonio. I like some of the areas closer to the beach area down there. Austin, just like Aimee was saying, very tight supply down there. You know, DFW, I think, is the center of the universe for the entire country for multifamily. If you're not in Dallas and Fort Worth, it's a highly competitive marketplace, very tough to find inventory, very tough to find people willing to sell you their property because just like what you were talking about, the compression of cap rates continues to make them more valuable every day. So then they trying to figure out where the heck can they take their money to after they sell, to what market or what product type they can do for an exchange. So I think that's probably one of the most difficult thing right now is supply and freeing up supply and people going into other different markets. Another things that I like too are secondary and tertiary markets where you're the only sheriff in town, or instead of having 100 supply, you have 20 or 10 or so. So I definitely like the secondary markets. Any feedback on the secondary markets at all, like whether it's Tyler or Abilene or some of these smaller markets?
Yeah, I love them too. I love the secondary markets. Lubbock is kind of a favorite of mine. It's got some good drivers like the university there, and it's really kind of a healthcare hub for West Texas. So even, independent of the university and its impact on the economy there, I think that market will be solid for a long time because it's such a healthcare hub. I like Tyler. Tyler kind of had some rough times in the 08-09 years, and it's still just recovering from that. But the great thing about that is that means that there's a lot of potential for more rent growth in Tyler. I like even some of the what we call ex-urban markets like Waxahachie and Commerce and Greenville that are almost commuter cities to Dallas-Fort Worth. They have low supply and so very low competition and typically very high occupancy, which makes them very easy to manage.
How about the home of Baylor University, Waco, Texas?
Oh, Waco, Texas. Waco's had some tough times these past few weeks here, but I love Waco. Great metrics. The growth in Waco has been fantastic and impressive over the past few years outside of the university.
It's all those people going to the Magnolia markets down there in Waco.
They've done a great thing for Waco, really.
Certainly have.
And, it's a beautiful part of the state. And I think, a little bit of publicity has really drawn people into that beauty. And so it's going to continue to be a solid market.
In fact, we see a lot of people that are actually asking for financing on properties in Waco because they watch, that Chip and Joanna Gaines, and they're thinking, boy, that looks so nice. I want to move there. Or I want to, be part of that Waco scene. And these are people that are from California, and they're tired of some of these large urban areas, and they want to move down to these secondary, tertiary markets like Waco and being tied into a major university like Baylor. My question that I have for you, Aimee, if you can think about this, is just this rental growth. I mean, we've talked about it before. Last year in the B and C space, it was $800. On a 2-bedroom unit. This year it's $900. Next year it's $1,000. At what period of time does the train come off the tracks? I mean, I'm a little concerned about where this rental growth is and can it be supported going forward?
Yeah, very good question. There's a few things that could derail that rental rate growth. Overbuilding, too much new supply, a push of rent to income ratios, meaning that rent increases just so much that tenants can't afford to pay it anymore. I think we've still got a lot of room there. When you look at rent to income ratios, Dallas is one of the lowest in Texas as compared to major metros.
Yeah, and I think that's where I hear quite a bit. Where the movement is that what they used to be accepting is 2.5 to 3 times income for the rent. But if you go to markets like San Francisco, as an example, where people typically make the same amount of money as they make in Dallas for income, now they're doing 1% or 1.5% or 2%. I mean, it's not. They've changed the criteria from 2.5%, 3% down to say 1.5% to 2%.
Oh, absolutely. And Texas as a whole really trails the nation in terms of rent to income ratios. So we still have a lot of room to really raise rents here in Texas as a whole. But, the other thing that could derail rent growth is employment. If unemployment spikes, if all of a sudden Toyota announces that they're not coming anymore, which seems highly unlikely, but
I see the cranes every day at
they're
my
kind of
office,
committed
so
at this point, aren't they? Yeah. But, any major shifts like that could definitely impact rent growth.
Sure, like Dallas turns into Detroit and everyone moves out of the city. That's the analogy I like to use, right?
Yeah.
So, any other parting words of wisdom that you have for the group? Any last minute tips for an aspiring apartment owner or someone who's a borrower of ours that wants to increase their likelihood of having a successful outcome with an appraiser?
I think the key to a successful outcome with your appraiser is getting them the information they need. I've said that many times, but it really is important. And having a dialogue with the appraiser. We really do want to hear from you guys as buyers and owners. You guys are the market, and our job is to reflect the market. So we're very open and receptive to what you guys have to say, what your thoughts are, what your opinions are. That's all really good data for us. So we love to hear what you guys have to say. So be in touch with us. Be open with us. Give us the story. Every property has its story, and we need to hear that story. So if
Paul,
you give us the story.
Anything to add there, Paul?
Nothing. Aimee does a great job. The CBRE platform does a great job. Tony Lenneman at CBRE does a great job. The entire, the CBR team, we have a good relationship, as we do a lot of appraisals. We do one out of every 3 apartment loans of the B and C quality type in Dallas, Fort Worth, Austin, San Antonio. So we're very active in the market. And so with the help of Aimee and her crew, we owe a lot of our success to them. So they really have an insight about what's going on in the marketplace. So Mike, thanks for joining us in the podcast. Aimee, thanks for joining us in the podcast. We appreciate it. And thanks for you listening, for joining us in the podcast. We'll talk to you next time.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.